line.
Hello and welcome to Money Matters. I'm Sarah Peterson here with Dean Greenberg and Todd Glick of Greenberg Financial Group. Hello, gentlemen.
Hello.
How are you today?
We're good, and I'm so happy to be introducing Todd to the community.
Absolutely. Let's get to know Todd, shall we?
All right.
For all those viewers who obviously don't know you yet, tell us a little bit about your background and what you do at Greenberg Financial Group.
Yeah, so my name is Todd Glick. I just joined the firm about 18 months ago and have just absolutely loved my time with Greenberg Financial. And for people who do know, I'm actually was raised somewhat by Dean Greenberg because he was my lacrosse coach for 4 years in high school. So we go way back. We've known each other for a long time. He's known me from a little kid all the way up, growing through college where I did graduate from ASU. Not the most loved thing down in Tucson, as those Wildcat fans say, but I am a devil, and I've graduated with a finance degree in 3 years and then worked for Greenberg Financial. It's actually a really interesting story of how it came about because I was going to join Northwestern as an insurance salesman, and I was ready to really sign on full time. And I gave Dean a call knowing him as my mentor, and I said, hey, Dean, can you look at this contract and make sure everything looks good and everything looks well? Well, I did just that, and he said, Todd, do you want to be a salesman or do you want to be an advisor? I said, well, Dean, I want to be an advisor, of course. He says, then come work for me. And then after having that conversation of really understanding the difference, I decided I'm going to go work for Greenberg Financial Group because it's not just about the product with Greenberg Financial, it's about the relationship. It's about the long-term relationship, and that's what I'm all about. That's why I joined this industry in the first place, is to help people and educate people on something that isn't educated about. You talk about on the show all the time. There is no financial literacy courses that are really brought to the public and masses. That's where we're here to bridge that gap, and I'm really grateful to have that opportunity.
I think it's such a blessing that you all can speak to it in a manner that we not only understand but can appreciate, and that I never have seen you sort of talk down to someone or make them feel less than for not understanding these things, because like you said, it's really not a part of our education, and most of us are a little intimidated to have these conversations.
An interesting tidbit to Todd too. Obviously, I've coached for a long time, and on senior night, you meet with all the kids and stuff. And he showed this to me about 3 months ago, but 6 years ago when was it 6 or 7? Probably 7 years now.
Yeah, something like that.
Right? He showed me on senior night that I said into the camera that this kid will come work for me one day.
That's so awesome.
And that was like a year and a half, 2 years after I hired him, and we've been working together. So we obviously must have known that at some time, but for that to come to fruition and to be part of it, and for him and Dylan just do a fantastic job. Hands down, I'm a very lucky person to be able to navigate to find two young guys that want to be mentored and learn and be as smart as they are. And the relationship with our clients is unbelievable.
To be honest, I think they're also a great example of this next generation taking initiative to learn about these things, because it's not been something that traditionally people don't worry about their financial health until it's probably too late. And as we've talked about before, my grandparents they had a job their whole lives. Many people have the same job their whole lives. Then they retire, they get a pension, that's it. And that's not the way of our world anymore, which is a blessing in many ways, but there's a lot more tools in our toolbox.
We live in a world of instant gratification now, right? And so for the young people, that's all they see. It's social media, it's swiping. I want to go, what's next? And they have no idea. Time is their most valuable asset that they have right now. And they don't take advantage of it because it doesn't give them that instant gratification. Putting money away for when you're 65, that doesn't give you any joy today. Mm-hmm. It gives you joy when 40 years when you finally retire and you've built that nest egg for yourself. So that's what we see most, is trying to educate people. Don't just go on that first instinct. Go for what's going to be there in the future.
It's a hard nut to crack sometimes when someone looks at you and says, put this, $50,000 away now and it'll grow tax deferred. It's like, but what if I need that? It's a fear, right? What if I need it tomorrow? What if so what you do, I think, is take that fear off the table when you have a plan.
Talking about that, it's even more amazing when somebody comes into a windfall because, God forbid, somebody passes away or some other thing that happens, they get left some money, or they have an injury, and it's an insurance thing, right? They come into me, what you said, $50,000, $100,000, and they're 25. I tell them, act like you've never seen this money in your life and you'll never have to save for retirement. And they go, that sounds great, that sounds great. 3 years into it, 5 years into it, 10 years into it, they start nibbling at it to the point that it doesn't grow the way they want it. When you put $100,000 away, it's going to be worth millions possibly down the road because you got 35, 40 years for it to grow. But if they never got it, they would have lived fine without it. But because they got it, they changed the whole habits of what they're trying to do. So then I try to just at least say, stay with good debt, not bad debt. Use this on investment purposes, not on paying off your credit cards.
And that conversation we've had in the past, I think is worth having again about not all debt is bad debt, but people are really, as they approach retirement, obviously wanting to take a lot of that debt off the table. And so I think working with a financial advisor that can kind of help you steer you whether this is good or bad debt is important.
Yeah, absolutely. And the snowball effect is kind of what some people call it, is when they're trying to pay down debt and you're getting to the point where you see all these debts that you have, you want to find what's the highest rate on the highest principal, right? It's not always about, maybe I have a really high rate on a credit card, but there's only $100 I owe. Well, I don't need to pay that one down. I need to pay the one I owe the most on. So using a financial advisor and actually able to calculate how much interest am I looking at over the next 5, 10 years and which one is the best to go over and pay first, then you can snowball into the other ones. If you're always behind the 8 ball, you're never going to make any real progress.
You know, one of the things we try to talk to people too, if they can, is go get another credit card that you can transfer the loan over for 0 interest for the year. You know, and that way you get the money at least you're paying is going towards
Have
the
you ever
the balance.
seen, there's I can send it to you, but I mean, there's some really interesting things, you know, on social media, as you were saying, people who, that's what they do all day long is kind of help you figure out there's this new credit card and the points and what the value is. And I think it's worth doing that every year. If you have the same credit card you've been using for a couple of years, you may be missing out on a lot of value elsewhere.
But if you're missing payments, you're not going to get that other credit card.
Yeah, exactly.
So people don't realize how important their credit is. Even when you're getting car insurance, a few people found out that they had bad credit, that their car insurance was so much higher because their credit wasn't good.
Absolutely. Well, let's get, first things first, don't get into bad debt. That phone number is 520-544-4909. We'll take a quick commercial break. We'll come back and talk more about why your money matters. We hope you stay with us.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg and Todd Glick of Greenberg Financial Group. Todd, I really want to talk to you because I know you and Dean work together, but you have sort of different strengths and you love to work with, you know, annuities and insurance. And I want to talk about this notion of safe money and how you work with your clients on that.
Yeah, and it all comes back down to the financial plan. We know that to understand whether annuity is going to be right for you, it has to cover a couple things first. Has to cover your goals and objectives, has to equal your risk tolerance, and it has to equal your liquidity needs. And that's one thing that isn't talked about a lot in annuities. Because with annuities, you have something called a surrender schedule, something that locks your money up for a period of time. And if you take that money out of the annuity, you're going to be assessed a penalty for doing so. And so for when people are looking at retirement and they say, okay, I need some money taking out, and you look at your surrender rate and, oh wow, I'm going to be charged a huge rate because it wasn't brought up in the plan beforehand. So what we actually do is we go through all the financial plan and we discover, oh, we have $200,000. That's 20% of your net worth sitting in a checking account, earning nothing, right? Why is that? We ask the client. We just haven't found a better place for the home. We know we should be earning more interest, especially now in this interest rate environment with interest rates double, triple than what they were 2-3 years ago, right? And when interest rates are as high as they are now in this current environment, what annuity companies can do is offer better products. And so we're seeing annuity rates that we've never seen in the last 3 or 4 years, really since 2008, what does that coincide with? One of the most feared events that happen in the marketplace, right? So when we're looking at annuities, we're looking at the goals and objectives, the cash flow, and whether it meets the long-term liquidity needs throughout the plan. So there's a couple ones that we could look into. The first one that is best for safe money is the MIGA. It's kind of like a CD with an annuity company. And what a MIGA stands for is a multi-year guaranteed annuity. And like I said, it's essentially just a contract with an annuity company saying the annuity company is going to pay you a set rate of interest for a set number of years. And after that, you can either decide to take all the money out or you can let it and go in for another term depending on what the interest rate is at that time. So you can do 3 years, 5 years, 7 years. Right now, you can get a 5-year MIGA around 6%, around 5.5% with A-rated companies. And that's another thing with annuities is they're not all apples and apples, right? Because there's ratings on these annuity companies. You're going to have A-rated companies. You're going to have B-rated companies. Guess who will always offer the better rates? The B-rated companies. Why is that? Because they have to attract you to that product. It doesn't mean it's a better product. It just means it's a more risky product because if that company goes under, well, so does your annuity. So it's a multifaceted approach to annuities, and it all starts with the financial plan. So many times we'll discover these huge amounts of money earning nothing when they could be earning more.
Annuities kind of have a sort of a negative connotation to a lot of people, and so probably they just need to be better educated about it.
I think a lot of it's because a lot of these annuities were purchased in low interest rate environments. The way annuities are able to really outpace and outperform is when interest rates are high. So this is the time when you can really start being attracted to annuities, and that's why we're seeing record sales right now.
And then the other thing is, with the annuities, where the rates are right now, it will give you the type of return that you actually think you were going to get before because you can lock some in and everything else. The fixed index annuities, okay, that are part of the S&P and stuff, are so much better today than they were 5 years ago, 10 years ago, 20 years ago. You know, and one of the things, if you're looking at annuities, obviously they pay out big commissions, okay? We try to do it always on the trails because we don't like taking an upfront commission for someone and just be a salesperson. Because if you do that, then what incentive do you have to continue a relationship with that person until that annuity is done as something else? And we don't like that. So when you're dealing with the trails, it just becomes part of the same thing as a management fee of assets under management. And it just becomes part of the whole entire plan.
And I'd like to second on that because you see a lot of times on these LIRPs, these life insurance retirement plans, these whole life cash value life insurance, they're kind of like annuities because they offer these huge payout commissions to the agents that sell them. And there's really nothing for the agent to incentivize them to continue that relationship years and years going down the. And so when you look at annuities and life insurance policies that are designed somewhat for retirement, they're very complex. And so you need someone that's going to be watching over that complex vehicle year after year, not just 1 year.
Well, and as we talked about, this is, not a set it and forget it type of situation. So when someone starts to work with you, we need to keep revisiting this plan as their life changes, as, time goes by. This is not something that we just do. If you haven't heard from your financial advisor in years, then there's a problem.
And if you don't like annuities, there's other options for safe money as well. I mean, Dean will speak a little bit more about this, but we have a lot of corporate and treasury ladders that we're building 1 through 5 years that offer really attractive rates of interest with really safe investments.
Right, and then we also know, we put a kicker in there, that if interest rates start coming down over the next 5 years, we're going to make the appreciation back on the entire portfolio in the fixed income market. Because if you think about this, before interest rates started going up, and we knew they had to go up sometime, we reduced our long-term bond funds to short-term bond funds. Then we got out of our short-term bond funds because they were going up and moved into short-term maturities. Now we go 1 to 5 year ladders with these short-term government bonds, treasuries, all good, A-rated or better. And what we do now is we put the kicker on where it will appreciate, which is the 20-year bond in the ETF. If interest rates come down, that's going to go up tremendously. It came down from 150, 160, all the way down to, I think, 80 or 79. Now it's about 89, and it can go back up, I think, easily over time to 110, 120 when rates come down. It has to happen. If rates come down, it has to go up. It's the way it works.
Even without a crystal ball, you just know these things. That's what it is.
The what?
I said even without a crystal ball, you just know these
There are
things.
certain things that are going to happen that most people don't talk about. If rates go up, bonds go down. Rates come down, bonds go up. And before it was very difficult because you're earning nothing on those bonds. Now at least you get 5% or more.
And that's why a lot of people aren't understanding this. The normal 60-40 portfolio, 40% in bonds, 60% in equities. In 22, equities got killed. But what also happened in 22? Interest rates went up. So what happened to all those bonds? They lost a lot of value. And so the thing that was supposed to protect you when equities go down actually also hurts you.
Bonds took a big hit this
That's why
year.
so many
kidding.
people looking at their 2022 statement says, what's happening right here? And then they're looking at their 23, seeing S&P up so high, not realizing that's really driven by 7 or 8 stocks. And they say, well, why is my portfolio flat or even down? When they're mostly in bond funds, not in those individual bonds where you're guaranteed the principal back. And that's the big difference between bond ETFs and individual bonds.
And that's what sets us apart. We manage the money in-house by ourselves with all the experience I have. Because we started off as a money management firm back in 1988, managing money. We dwarfed into a financial planning money management firm starting in 2019 or so.
You know what? We always run out of time. I was just about to ask you a question, but let's take a quick commercial break. That phone number, just in case you haven't seen it yet, 520-544-4909. We will take a quick commercial break, and we'll come back and talk more with Dean and Todd about Your Money Matters.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Hello, and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg and Todd Glick Jr. I keep forgetting to say junior, sorry. He's a junior. I would love to talk to you about, we've been talking about annuities and insurance, but I would love to talk to you about how taxes play a part in all of this.
Yeah, and there's a couple multiple levels that taxes will play into a financial plan. But the thing I love about our financial planning software is it has something called the tax planning tool. And obviously, we're not tax specialists, so we don't give specific tax advice, but we're able to at least estimate and look at the plan from a high-level overview. And this tax planning tool, what it really is good for is looking at whether we do a qualified charitable distribution or a Roth conversion. Does it actually save us money in lifetime taxes? And so what this plan does is say we have a 5-year window until RMDs start, and we know that we're at a certain tax bracket. And we have a little bit of room, maybe $20,000, where we can take extra income before getting into the next bracket. So let's take that $20,000 in those early 5 years before the RMDs start, and does it actually save us lifetime taxes over the course of the plan compared to just taking it at RMDs when we have to take it? And that plan with the Monte Carlo will actually show you an estimation on what you could be saving on taxes. Those are just one of the things we can do. The second thing is actually on the money management side. Dean could speak a little more about this, but when we have a brokerage account or a joint brokerage account, those accounts are taxable on the capital gains. So the IRAs, the 401ks, those are things that are tax deferred. So you don't really have to worry on the yearly basis on whether you have a taxable gain or taxable loss. But when it comes to the individual accounts, that's when we really have to see and be cognizant of, do we have a really high realized gain? Do we have a low realized loss? Okay, how do we offset that going into next year and setting ourselves up?
Do you have anything you want to expand on? He said he wanted you to.
Taxable gains.
Well, I mean, when you have taxable gains and the huge taxable gains, right? What you need to do is obviously sit with the person and see if they have any tax loss carry forward. If they don't, you got to see what tax bracket they were in. How much more can you take in income that will put them in another tax bracket? Because you don't want to do that. So say you can't do a lot of things. Then there's strategies that we use to be able to at least keep the position pretty much where it's not going to go down, if it goes down tremendously, you've already locked in a higher price. And we use option strategies to do that, things that I've been dealing for almost 30 years in. And, you know, it has to do with covered calls, buy insurance ports, it's a lot of different things. And then what happens is over time, you reduce that position. Because I've seen people with 30, 40% allocations into one stock, and that's a lot.
Doesn't timing play a huge role in the tax planning? I mean, just not how much money you have, but when and where you take it from when you need it.
Absolutely, and I think really, to me, timing comes into play on the sequence of returns, and that's where the Monte Carlo comes into play. Most financial plans that you're going to get is going to show you a steady 5% return you're going to get every single year, because that's what a balanced growth account should get over a 10, 20-year period. If you're a growth account, you're going to get 8% every single year. That's unrealistic. There's no market that's going to pay you 8% every single year. We're going to have down years of 20, we're going to have up years of 30. The average may be 8%, but the sequence of returns is what a lot of planners miss. Because if we start retirement with 3 negative years, 3 big negative years, and our average return comes out to 8%, well, it doesn't mean that we actually are going to make it, because if those 3 negative years that we're pulling out of the account, that money is not going to be there when the market comes back. And so what the Monte Carlo simulation does is it takes 1,000 simulations of 1,000 different return sequences. And that's what the real value that the Monte Carlo adds to the financial plan. Otherwise, what you're doing is just putting an average return. Anyone can do that in Excel, right? And that's what most people would come in. I've looked at my financial plan. I think I can make it. Based on this average, if I get an average return of 6%, I can make it. Okay, well, what happens if you get a negative 20% drop in year 2?
One of the things we try to do, what's the worst 10-year history that we know of? 2000 to 2010.
Yeah.
We put every simulation through the 2000 to 2010 and show them if that's where you retired in 2000, which you would have been crying in my office, and I've been holding your hand to get through this, like they did, to 2010, because we had 250% move down. Then we show you where you are in 2010, whether you're taking out money or not taking out money. That's realistic. We want to show realistic type of returns to people.
My father retired in 2007 or 8 because.
And how scared was he?
Oh, it was.
Especially if you didn't have a pension.
It's just, yeah, I remember, I mean, because you just think at that time, you're at the age where, you know, how much time do you have to make it up, right? It's not, and you can, I mean, he was actually in his 60s, but do you want to? I mean, that's the time where you're trying to.
Well, you looked at a Y2K, wow, we got through it, the world didn't blow up. I'm done.
Right.
And then they blew you up. You know what I mean? Those 2001 and 2008 just crushed people. And a lot of people never got back in.
Yeah. Well, I mean, this is why I love the fact that you can plan sort of for the worst. You know, my parents have that game, worst case scenario, and they really love to play it.
Can you handle this?
Exactly. There's a part of the plan where it literally says, what if scenarios? And we can build out, what happens if Social Security gets cut by 25%? What happens if inflation runs at a 5% clip for the next 20 years? What happens if long-term care expenses come into play that we weren't planning for? What happens if investment returns are lower than we expected? We can run every single one of those scenarios with each other, isolated. That's what's so cool about the plan. I geek out a little bit about it because we can really show people and calm anyone's needs. There's people who says, oh, but what happens if they cut Social Security by 25%? I show it to them and their plan's still at 99. And then I just relieved a fear that they thought they could never really get over by just showing them that there still would be fine.
It is a very interesting time of life because I have a family member who's retired and she's on a fixed income and is still so spry and loves to go and enjoy. And it's like, oh, I really want to do this, but Got to ask my financial advisor. Got to make sure I can
Does
afford
she
to
have
do
a
this.
plan?
She does have a plan.
Okay.
She does have a plan, and she's excellent at it. But it's a different mindset, you know, and as we get older, that mindset shifts.
You've gone your entire working year through accumulation phase. You're hiking Mount Everest. But what people fail to realize is most people pass away on going down Mount Everest. It's the going up's the easy part. It's the decumulation phase. It's after you've accumulated your nest egg and now you're getting it out. That's the hardest part to master, and that's where a planner really is needed to be put into place.
I mean, that's the scary part. Think about that. Your whole life, you're trained to make money. Make money, make money, make money. Stop, you have no income. And now you're in the deaccumulation phase. How long does it last? And that's what we try to show people.
I think also on top of that, though, as you just said, your life, you've had one mindset. So regardless of what that is, shifting to another mindset, especially you get older, you know, change is hard for a lot of people. Shifting that mindset, it takes a minute. And I think having somebody to hold your hand along the way, that's imperative. Also someone giving you, I mean, what you're doing is giving me concrete information.
Right.
You're saying, if this, then that. That's what I need to know. Okay. If this happens, I'm still okay. If that happens, I'm still okay. If you don't have that, then what do you have, in my opinion? Right?
I agree.
So without a financial plan, you're stuck not knowing whether or not you can do the things that you want to do and live the life that you have earned, you know, since working age.
And as you've been saving, you've had this built up this habit. But guess what? All you have to do is realize that we're going to show you your bottom spending and your top spending. You stay within that range, you're going to be just fine.
Why are you looking at me like that? He always looks at me like that, as if I'm the bad spender in the family. That phone number is 520.
I didn't say a word.
You looking at me like that.
I was looking at your nice blue coat.
Okay, thank you. That phone number is 520-544-4909. Please give us a call. If the phone lines are busy, have patience with us. This is an opportunity for you to get your financial health reviewed and let you know whether you're on the right path. And guess what? It is complimentary. Other financial advisors charge thousands of dollars or more for this. This is for the viewers of the show as our gift to you for sitting and having this time with us and getting educated. And to me, it's a no-brainer.
And just because it's free doesn't mean we don't think it's worth it. A lot of people say they charge it because it's worth something then. I don't go under that. I go under the fact that what we do is great, and if you want it, you see it, and if you want to deal business with somebody, then you come back and do business with us.
Absolutely.
That's been my whole theory the whole time.
And if they
Teach
have...
them.
Educate all day long.
Educate all the time.
And you're a product of that, and I love it. So thank you both for spending time with us. And it's so great to see you again and all the wonderful things that you're doing. And thank you for taking the time with us on your road to retirement. We hope you'll join us on the next show.